Good morning, students and viewers. Today in this particular lecture, we are going to discuss about your course MMPC 004 Accounting for Managers, and in this particular course, we are going to discuss about the introduction to accounting. When we are talking and especially seeing the profile of our students, who many of them who may not be having the commerce background. So for them it is going to be very useful to go through this particular unit, which is Introduction to Accounting, because this particular unit deals with what is accounting, what are the principles on which the accounting entries are made, what are the conventions which are followed in accounting, and what are the various types of accounting, and how the accounting acts as an information system for the business as a whole. Apart from the business, it also acts as an information system for the outside stakeholders, which may be regulatory agencies or government or banks and financial institutions and many more other stakeholders. So now, when we talk about accounting, and those who are not familiar with the process of accounting, they must be thinking that accounting is going to be simple. What we have to do in accounting? Take all the expenses on one side, take all the revenue on the other side, find out the difference to find out the profit. If the expenses are less than the revenue, then you have a profit, but if the expenses are more than the revenue, then you have a loss. But it is not that simple. It is simple, but it is not that simple, because you have to make certain adjustments for the revenue and expenses, and what kind of revenue is going to go into which financial statement, that you have to decide, and that the accounting principles tell you where this particular entry is going to go. So now let us start with the definition of accounting. First of all, what is accounting? When we talk about the definition of accounting, so now these slides are. Now, before we talk about the definition of accounting, is basically the process through which the accounting transactions are recorded and analyzed and classified. Recorded, classified and analyzed. So that is basically the definition of accounting. In gist, it is this. So when we are talking about what is going to be recorded? The question is, what is going to be recorded, classified and analyzed? Now, when we are talking about the recording of transactions, now the transactions will pertain to whether it is going to be your revenue or whether it is going to be your expense. That is one. Another one is going to be whether it is an particular account is affecting your asset account or a liability account. So basically in accounting, we are dealing with the four kind of accounts. One that which pertains to your income account. Income account will include both your revenue and your expenses. And another one is the items which come in the balance sheet, which is going to be your assets and liabilities. Now, before talking about this, let us talk about the various accounting conventions which we are having and based on which these entries are being made. Now, first one is your business entity concept. When we are talking about the business entity concept, the gist of the argument is that the business is different from the owner. That means a business is a separate entity and owner is a separate entity. Now, if I ask you a question, capital is contributed by the owner and the business is owned by the owner. Business is also owned by the owner and the capital is contributed by the owner. But the capital is shown on the liability side. Why it is shown on the liability side? And similarly, when the business earns a profit, what happens is the profit is added to the capital. Profit is added to the capital. So, in fact, by earning when the business is earning a profit, it is increasing its liability. Now, what is the reason or the logic behind that? The reason or logic behind that is your separate entity concept. Now, when we are talking about the separate entity concept, the very basic thing is the owners of the business are separate from the business. But that is for your accounting purpose. That is for your accounting purpose. But in case of the partnership firms and sole proprietorship firms, what is going to happen is, for the purpose of accounting, if they are creditors and the business has not paid to them, creditors means to whom the business owes the money, to whom the business owes the money. The business has to give them the money. Now, if the business has not paid to the creditors will have recourse to, the creditors will have recourse to the court of law, and the court of law can direct the owners to pay the creditors from their personal wealth. So, but for accounting purpose, we are taking your business as a separate entity and owner as a separate entity. Now, when we talk about the company form of business, in that too, the shareholders are separate from the business. But in exceptional circumstances, very exceptional circumstances, when the court finds that the promoters have misused the funds of the money for their personal gains, though we have a concept called as the lifting of the corporate wheel. So, there the courts can intervene and direct the promoters to make good the losses which has been done to the business or to the creditors who have given money to the company. So, that is your business entity concept. So, always keep in mind, business is a separate entity, owner is a separate entity. And now, when we are going to make your general entries, this concept is going to come in handy for you. Second one is your money measurement concept. Ankur ji, pehli slide. Now that was your business entity concept. Then comes your money measurement concept. When we are talking about, Ankur ji, first slide, first. Now when we are talking about the money measurement concept, only those transactions are going to be recorded in the books of accounts which can be measured in terms of a common unit, or which can be measured in terms of a common denominator. And what is going to be that common denominator? That is obviously that is going to be money. So only those transactions which are being capable of being recorded in terms of monetary units are going to be recorded in the books of accounts. And the extension of this, the third concept is your consistency concept or going concern concept. Now, according to this concept, the business is going to last for foreseeable future. According to this concept, the activities of the business are going to be last for foreseeable future, provided there is no evidence to the contrary. Now, when we are saying there is no evidence to the contrary, what does that mean? Now, if the business is making continuous losses and the losses has wiped out the entire net worth of the business, then what is going to happen? If the entire net worth is wiped out, what is going to happen? Creditors and banks, they are going to ask for their money. Now, since the entire net worth has been wiped out due to losses, the business will not be able to pay them. They will file for the insolvency of that company. So, until and unless these kind of evidences are there, which provides that in the near future, the business will not be able to continue its operation. If these kind of evidences are there, then it is not going to be a going concern. Now, in recent times, what has happened is, many of the corporates, there the promoters have misappropriated the funds of the company, and a huge amount of the funds were diverted from the company's accounts to their personal accounts. So, on finding this, the auditors had refused to certify those companies are going to be going concern. So, if there are evidences present through which the auditors can find out that in the near future this company will not be able to survive, then they are well within their rights not to certify that particular company as a going concern company. Now, another concept is the concept of conservatism. When we are talking about the concept of conservatism, this particular concept tells us that provide for all the possible losses and do not anticipate any gains. Provide for all the losses and do not anticipate for any gains. Now, what does that mean? In recent quarters, if you might have seen the quarterly financial results of many banks, and what you would have observed is or noticed is that for many banks the profit has just doubled, or even for some banks it has become, for that particular quarter, it has become 2.5 times. So, from this information, what you can infer? That the business of the bank has grown tremendously? That is not the case. Although the credit growth in the economy is healthy, But that is not the case. The case is, since they were following the process of conservatism, so what they had done in the previous quarters was that in anticipation of the bad loans which are likely to occur, and even the RBI guidelines are there. So in anticipation of that, what they had done is they had made provisions for these losses. These losses have not occurred, but they were likely to occur in the future. So, following the principle of conservatism, what they had done is, before occurring of those losses due to bad loans, they have already made the provisions for the bad loans which are going to occur in the future. Now, in this particular quarter, what has happened is, many of those firms or individuals who were not paying earlier, they had started paying. So, now the scenario has changed. People have started paying. So, what has happened is, they had made lesser provisions, due to which the profit has zoomed up. So, making provisions is obviously following your concept of conservatism. Now, your next concept is materiality concept. Now, when we are talking about the materiality concept, according to this concept, when you are recording a transaction, if it is of such a nature that recording that particular transaction would entail much more expense than the value of that particular transaction, then that distinction has to be ignored. Let us take, for example, my office might have issued me some stapler, paper stapler, pens, whiteboard markers, etc. And generally, these items which are issued, they last for more than a year. Now, any item which lasts for more than a year, that is taken into a capital expenditure. And if the use of that item is within that particular year itself, accounting period itself, then it is taken as a revenue expenditure. But in order to ascertain how much has been used, the cost to calculate all that, to record that all information would be much high. So, what an accountant will do, that instead of taking it as a capital expenditure, he is going to take it as a revenue expenditure. That means he is going to take it into the profit and loss account for that particular year. So, in case if the cost of recording and classifying those transactions is high, then accordingly the accountant will take a decision whether to take it into the capital account or into your revenue account. Another one is your consistency concept. Now, when we are talking about the consistency concept, that says that whatever accounting policies you are following for the previous year, that should be maintained. Why that should be maintained? If that is not maintained, your financial results would not be comparable. Take for example, that for the previous years, a company was following a particular depreciation policy. Now, when we are talking about depreciation is a non-cash expenses, but it has a bearing on your profit and loss account. And so, in the previous year, it was following a particular policy, and in a current year, it changes its depreciation policy without any reason, just in order to avoid taxes. Now, by changing the depreciation policy, what will happen is a higher amount of depreciation would be charged. So, the profit would be less. So, just by changing the accounting without any material change, just by changing your accounting policy, what has happened is you have been able to manipulate the profit and loss account and the consequent taxes which has to be paid. So, consistent accounting policies has to be followed. And if the circumstances require that the accounting policies has to be changed, then there should be a sufficient justification for that. Along with the justification, the company should also work out that due to the change in the accounting policy, what has been the effect on the profit. So, that is your consistency concept. Then another one is your periodicity concept. Now, when we are talking about the periodicity concept, this concept basically says that the accounts of the business are going to be prepared for a particular period. Now, that particular period is generally the accounting period. Now, in India, the accounting period starts from 1st of April to 1st of April to the 31st of March of the next year. So, that is your periodicity concept. Now, another concept is the concept of full disclosure. Now, what is the basic purpose of your financial statements? Financial statements are your trading account, profit and loss account, your balance sheet and cash flow statements. These are the four basic financial statements. Now, when we are talking about the financial statements, the basic purpose of any financial statement is going to be to present a true and fair picture of the state of the affairs to the stakeholders, to present a true and fair picture of the state of the affairs of the business to the stakeholders for a particular period or on a particular date. So, if you are concealing certain information or misrepresenting certain information, what you would be doing is you would not be following the convention of full disclosure. Take for example, there was a very famous corporate scandal in 2007 where one of the software companies had manipulated its accounts. And how those accounts were manipulated? The bank balances which were shown in the accounting statements, they were highly overinflated, and the auditors failed to check with the bank regarding the actual balances which are with them. So, due to that, high profitability was shown, and once that came into light, that particular company, the stock of that particular company just crashed, and another company had to take over that company because it was a big company at that point of time. Now, let us talk about the definition of accounting, which we were talking in the beginning. The first definition is by the American Institute of Certified Public Accountants. Accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money transactions and events, which in part at least of a financial character and interpreting the results thereof. So, if you look at this particular definition, and analyze each of the words. The first, it is the art of recording. Now, at the recording stage, the very first stage is the voucher preparation. Then, classifying that particular transaction, whether it is an income, whether it is your expense, whether it is a capital expenditure, whether it is a revenue expenditure, that you have to classify. Then, all similar type of accounts has to be consolidated. That means summarizing those particular kind of transactions. So, let us say as of 31st of March of a particular year, you want to know the total amount which has to be paid to the creditors. So, only by summarizing all the creditor accounts, there may be hundreds of creditors accounts in your books, you would be able to know what is the amount which has to be paid to the creditors. And all these transactions should be in the form of financial transactions. That means that they should be able to be measured in the terms of money, and interpreting the results thereof. Once the accounts have been summarized, then you prepare the financial statements, and whatever the information you get from those financial statements, you interpret that according to your need. If you are a banker, you would be more interested to know about the solvency position of that company, and the liquidity position of that company, because you want to safeguard your interest which is due from the company and the principal amount which is due from the company. Second definition is also similar to the first one, but there, instead of the financial, we are using economic information. Now, Ankurji, next slide. Before we move further, we will discuss the common terms which are used in accountancy. Now, once it is clear to you that what these common terms means, it would be very easy for you to make accounting entries and make financial statements. First one is a transaction. It means an event of a business activity which involves exchange of money or money worth between parties. Now, let us say you have sold certain amount of goods to someone. Now, there are two ways of transaction. One is the cash basis. Fine, you have sold the goods to someone, he has paid you in cash. Or another is on credit basis, that he is taking the goods, but he is going to pay you after a period of 30 days or whatever the credit terms are there. So, which involves exchange of money or money worth between parties. Now, that promise to pay after 30 years is money is worth between parties. So, in accounting, we are going to record all the transactions which are either of economic nature or of financial nature and can be measured in monetary terms. Another one is your goods, and another term which we use commonly in accounting is your goods and services. Now, goods are the tangible articles or commodity in which a business deals. These items or commodities are either bought and sold or produced and sold. Now, at times what may be classified as goods to one business firm may be goods to other firm. Now, just let us, this you should understand it very carefully. let us say a manufacturing company is manufacturing a certain machine. Fine. That is going to be purchased by the wholesalers, who are further going to distribute it to the various users. Now, for the wholesaler, ultimately to the users. Now, since this machine has a life of more than 1 year, so the person who is buying that machine, for him it is going to be a capital expenditure. But for the company which is selling these machines, the receipt which it gets from selling these machines is going to be a revenue receipt. It is going to be a revenue receipt that would be shown in the sales. Whereas the factory which is further buying that machine, it is not going to show that machine in purchase. Rather than that machine would be shown in the balance sheet as an asset. So whether an item has to be included in purchase or sales, that will depend upon the nature of the transaction. Now, second one is the capital assets. What are capital assets? Capital assets are those assets which are used for generation of further economic activity, and that is very important, and the useful life of that asset is more than one accounting period. Fine. Now, right now, in front of me, there is a computer. Now, the university has purchased this computer. And obviously, the life of the computer is going to be more than 1 year. So, it is going to be an capital asset for the university. But there are certain assets with the university which we can't feel, touch, but they are assets. And these assets are known as intangible assets. The building, library, books, the motor vehicles which the university is having, laboratory equipments, computers and all that, they are capital assets. But university has certain intangible assets also. And what are those intangible assets? The brand name of the university. The moment you say IGNOU, what comes into your mind? One of the largest universities on the globe, catering to more than 6 to 7 lakh students per annum. So, and this goodwill which the university is having, that allows it to generate revenue in the future. So, we have the items like goodwill, patents, trademarks, copyrights, brand equity, design, intellectual property, etc. These are intangible assets. Now, you must have received your study material. Now, university enjoys the copyright on that material. And that is a very valuable copyright. Many of the universities want our study material. So, the basic purpose of telling you all this was that the capital assets can be of two types. One is tangible, one can be intangible. Then profit. When we are talking about the profit, the excess of revenue income over expense is called profit. It could be calculated for each transaction or for business as a whole. Now, देखिए, here one word which you will have to keep in mind is revenue income. Revenue income is the income which is coming from the operations of the company. Fine? Which is coming from the operations of the company. Now let us take the example of a hotel or a restaurant. In restaurant, what is the operation of a restaurant? It is basically to prepare food and serve it to the customers. So any income coming from those operations would be your revenue income. Similarly, let us talk about the loss. The excess of expense over income is called loss. It could be calculated for each transaction or for business as a whole. So when we talk about profit and loss, please keep in mind any capital expenditure is not going to go into profit and loss account. And any receipt due to the sale of your capital assets, let us say a machine has become obsolete, then that particular income would be shown as other income. That particular income would be shown as an other income. Now, let us talk about assets. All this we are going to deal in much more in detail when we are going to discuss our third unit, which talks about the preparation of profit and loss account and balance sheet. Now, let us talk about assets. Asset is a resource owned by the business with the purpose of using it for generating future profits. Asset can be tangible and intangible, that I have already told you. And some assets may have physical existence and some assets may not have physical existence. Now, let us talk about the liability. What is a liability? In very simple words, liability is what is owed by the business to the others. What is owed by the business to the others, that means whatever the business has to pay to the others, that is a liability. Now, how does a liability arise? Suppose you have purchased some raw material on credit and you have to pay to the supplier after 1 month, then the liability has arisen by that much amount. Similarly, now liability can be current liabilities and long-term liabilities and internal liabilities. Internal liabilities we will talk about later on, but let us talk about the current liabilities. The current liabilities are those liabilities which are going to mature within one accounting cycle or one accounting period. That means, let us say our accounting period is from 1st of April to 31st of March. You have bought certain goods on credit on, let us say, 1st of September, and the terms of credit specify that you have to pay back after 2 months. So, by 1st of November you will have to pay back. So, if we are preparing the financial results for the second quarter, then that would be shown as a current liability. Fine. And long-term liabilities are the liabilities which arises due to taking of term loans. Term loans are basically loans which the company has taken for a longer period of time. Then term loans, or if the supplier has supplied machine and those are heavy machineries requiring a huge amount of cash outlay, then even the suppliers may have given you credit, long-term credit. So that would be your long-term liabilities. Then we have another one is contingent liability. Now this is an important liability, but this is not shown in the main body of the balance sheet. It is shown in the footnotes. Now, what is a contingent liability? Contingent liability is a liability which is not existing but is likely to arise on happening or not happening of a certain event. So, first of all, contingent liability is not an existing liability. So, obviously, it will not be shown in the balance sheet, because on in the balance sheet, the state of the affairs on a particular date are shown. So, since the liability is not existing, so in the balance sheet it would not be shown. But it is likely to arise. Why it is likely to arise? Because of happening of certain event or not happening of certain event. Now, there are two very famous examples of contingent liability in India. One was way back in 2003-04 when ITC was fighting a case against the sales tax authorities, which had levied a sales tax to the tune of more than 300 to 4, more than couple of hundred of crores. Now, if the Supreme Court ruling would have gone in the favor of the tax authorities, that liability would have arisen. And if the Supreme Court ruling would have gone into the favor of the company ITC, that liability would have extinguished. So, the tax authorities had made a demand of few couple of hundred of crores by saying that lower amount of sales tax has been paid. Now, the basic idea, and another example is very recent example of telecom companies. See, when the telecom companies were given these airways, so in the license agreement, there was a clause for revenue sharing. So, one argument was that the telecom companies argued that the revenue which has to be shared should only be limited to the revenue generated from telecom activities, whereas the Department of Telecommunications argument was no, whatever revenue has been generated, there would be a share of that. Now, as a result, and that case was going on for many years. So, as a result, what happened? Both the parties went to the Supreme Court, and Supreme Court gave the ruling in the favor of the Department of Telecommunication. And as a consequence, companies had to pay thousands of crores of rupees to the government. And one company could not pay it or is unable to pay it. So, what has happened is that the government is thinking of converting its dues, whatever dues are there, into the equity of that company. So, the basic idea about telling you about this contingent liability was that it is important to reveal if there is any contingent liability, because the basic purpose of your accounting statements is to give full disclosure and give fair and true picture of the state of affairs. Now, another thing is your working capital. Now, when we are talking about working capital, in simple terms, working capital can be measured in two ways. First one is going to be your gross working capital, which is equivalent to your current assets. Another concept which we use in the working capital is net working capital, which is going to be your current assets minus current liabilities. Now, another term, capital and drawings. Capital is the amount which is contributed by the owners of the business, and drawings are when they withdraw amount of money either in the form of money or in the form of goods, either in cash or kind. That is called as drawings. So, when the owner is contributing capital, what happens is the liabilities of the business increases, and when the owner is drawing, the liability of the business decreases. Now, net worth. When we talk about net worth, it is basically what the owners see. One way of measuring the net worth is after paying all the liabilities, whatever the assets are remaining, that is going to be your net worth. Another way is when the business is going to be liquidated, and after paying all the liabilities, whatever is due to the business is going to be the net worth. Now, let us have a look at the two basis of accounting. One is cash basis and another one is accrual basis. Now, generally nowadays we don't follow cash basis of accounting, but just in order to have a understanding, you should know about this. Now, in the case in cash basis of accounting, income is recorded when cash is received and expenses are recorded when cash is paid out. Total of cash receipts and cash expenditure are shown in the financial statements, whether or not they relate to that period. Now, that is a violation of your periodicity concept. And another shortcoming of this is there is no matching of revenue against expenditure. Assets and liabilities are not recorded. Now, to overcome these shortcomings, nowadays accrual basis of accounting is followed. Income is recorded when it is earned. Expenses are recorded when they are incurred. Total of revenue and expenses are shown in the financial statement, whether or not cash was received or paid out in that period. Major shortcoming is it is a complex and requires estimation and thus may not be precise. Now, income would be recorded when it is earned. See, there is a difference between when it is earned and received. So, when you are talking about or making entries on the basis of cash basis of accounting, you are going to record sales only when the cash is received. But in accrual basis of accounting, the moment the sales happens, the sales is going to be registered irrespective of whether the consideration for that sales has been received or not. Similarly, when they are incurred, let us say you have employed someone and let us say you have employed someone and you have to pay them. He has done some work, but you have not paid him. So, that wages expense is going to be recorded. Wages expense is going to be recorded, but at the same time, another entry is going to be recorded which is going to be outstanding wages. So that was your accrual basis of accounting. Now let us talk about this. Through accounting, what is the kind of information which is generated? First information which is generated is about the liquidity and how efficiently the resources are being used by the business. Liquidity basically means whether the firm is in a position to honor its short-term obligations or not. Whether the firm is able to honor its short-term obligations or not. Whereas there is a very fine difference between liquidity and solvency. When we are talking about the solvency, we are essentially talking about the ability of the firm to generate future obligations. Then another type of information which is generated is about the profitability. Ability to provide financial reward sufficient to attract and retain financing. See, apart from the owner's equity, the business also takes funds from various other stakeholders. It may be banks, financial institutions, creditors. So when they want the information about the how profitable the business is in which they have invested. So the accounting information would be able to generate that. And the last one, but very important one, is when you talk about the accounting is ability to generate positive market expectations. Now, if you look at the capital markets, the moment the quarterly results of a company are out, and if they are within the market hours, and if they are good, and beyond the expectations and estimation of the analysts, that particular stock just shoots up 5%, 10% on a particular day. And similarly, if the results are bad, the stock goes down. So how does one know whether the company has done well or not? It is through the accounting information which is provided by the company in the form of financial statements. So another very important aspect of accounting is ability to generate positive market expectations. Now, when you talk about the software companies, generally when they talk to the investors after the declaration of the quarterly results or annual results, they provide guidance. Now, does that guidance comes from, or from where does that guidance come from? Obviously, it is from the numbers, and a large part of that guidance is based from the accounting information. Now, let us talk about the users and uses of financial information. See, when we talk about the internal users, that means the users who are within the organizations, who are part of the organization. So the internal users are the finance department, marketing department, management, and human resource department and operations also. Whereas the external users who would be interested in the accounting information is going to be your tax authorities, labor unions, in order to negotiate for wages and wage hikes, customers, creditors, investors, and regulatory agencies. They are going to be interested in the accounting information. Now, let us talk about how this information is being used. Now, there is a question before the HR department of the company. Can we afford to give our employees a pay rise? So, from where one is going to get answer for this? Obviously, from the financial statements, and financial statements are prepared with the inputs of accounting only. Now, another one is going to be likely question. What price for our product will maximize net income? Who is going to ask this question? The marketing people. So again, the answer is going to come from the accounting information generated. Similarly, which product line is more profitable? This question is going to come from the higher management. Again, answer is going to come from the analysis of the accounting information and accounting records. Now, see which product line is most profitable. When we are talking about that, now you might have observed that most of the car companies are hesitant to come with entry level models. They are hesitant to come because the accounting information which has been generated have revealed that the margins which are there are quite low as compared to the big models. Now, is cash sufficient to pay dividends to the stockholders? Finance department is going to ask this before asking or deciding on the dividends which has to be paid. It is the discretion of the company whether to pay dividends or not. But if the company decides to pay dividends, then that particular decision would be based on the accounting information. Now, is the company, any investor before investing in the company, whether it is going to be an equity investor or debt investor, is obviously going to ask, is the company earning satisfactory income? The answer is going to come from the accounting statements. So, how does company A compare in size and profitability with company B? And so, this was all regarding your Unit 1. So, in our next unit, next lecture, we will talk about how to make accounting entries, what are the rules of debit and credit, and do it. Now, in case if you have any questions, you are most welcome to ask them. Okay, thank you.